When it comes to investing, it can be very rewarding if done in the right way. Unfortunately, for many beginners who buy into the get-rich-quick mindset, it is a very easy way to lose money fast. For me personally, I stay away from day trading, swing trading, and leverage trading. Now, without going into too much jargon, these are instances where you try to make quick money in a short amount of time. If you look at the figures, around the 75% of retail traders, now these are people like you and me, lose money doing this. My name is Shuaib and I have been working as a corporate analyst with over 10 years experience in both the private and public sector. Here I'm going to talk to you about 6 investing rules I wish I knew before. Now, for the purposes of the video, the content will be tailored more for the beginner who is looking to start their investing journey. Also, it focuses on buying stocks as opposed to investing in property or other assets. Rule number 1, financial literacy. Take some time to learn and understand basic financial terminologies. Learn how money works. I'm not asking you to take an economics class, but knowing, say, how inflation works or how companies raise money to start their businesses. These things can go a long way so that you are able to make better financial decisions. For example, currently the rate of inflation in the UK is around 3.5%, meaning if your money is in a bank account at this minute, and you're getting less than this, then your money is actually losing its value. If you were looking to invest in a company, do you know how to read the company reports? If you were to look at a basic financial statement, would you be able to assess whether that company is in a healthy position or not? If the answer is no, then I would suggest that you educate yourself on this. When it comes to different sectors, you need to understand how each industry operates and the risks that are associated. For example, the pharmaceutical industry is notorious for this. A company may trial out a new drug. Initially, there may be positive results which push the stock price up. You hear the hype and you jump on the train only to know that later trials fail to meet any medical guidelines, and at which point the stock price has tanked and you've lost all your money. Those who know this would have stayed away or only invested a small amount to their portfolio. In a nutshell, before you start putting money on the table, you need to be well prepared. You need to research and know exactly what you're investing in. It may be that your investments don't give you those sky-high returns. However, you will definitely mitigate risks and the approach will be more measured than reckless. Rule number 2, investing is boring. If done correctly, investing is something that works in the background. What do I mean by that? You find an investment path, you stick to it. You ignore the noise and the hype and ideally have things automated. For example, most investment platforms, now whether it's Trading 212 in the UK or Robinhood in the US, they allow you to set up an automated system so that, say, every month after payday, a set amount is automatically taken out of your bank account and invested without you having to do anything. Now, if it's anything outside of that, you're not really investing, you're gambling. You're getting in and out of trades and your emotions are fluctuating. With each trade, you're actually gambling. In the beginning, you might be lucky and get quick returns. Repeating this will certainly lead you to losing your money. Instead, what you should be focusing on is having a long-term approach. You ignore the headline stories and you ignore the short-term peaks and troughs. You zoom out and you understand that in the beginning, the growth will not be exponential. However, doing it consistently and over a long period of time will see you build your portfolio with a solid foundation. In my personal case, I'm looking to invest at least over a 20-year period. Now, in that time, there will be downturns and gains in performance. However, over a long term, the micro changes will not matter. And because I will have been consistent throughout, it will even out fluctuations. Rule number 3, only invest money you can lose. I'm not trying to scare you out of investing. What I mean by invest money that you can afford to lose is you need to understand that your money will be tied up to your investments. So for example, if you need to pay rent or mortgage and are planning to take the money out and then put it back in again, it's not going to work. Also, if you're desperate for money and hoping your returns will grow quickly, again, this is not going to work. You have to be okay with putting your money away for a long time. You should have at least a basic money management plan in place. Each month you know the amount of money that comes in and what your expenditures are. Also, it is vital you have some sort of an emergency fund in place so that if you were to lose your job or something unexpected happens, then at least you can manage this. Another thing that would really help boost your long-term gains is, for example, so let's say you get a pay rise of 5%. Instead of increasing your spending by also 5%, you use that money and you invest it. You act almost as if you didn't get that rise. Now, by doing this, you're now investing an extra £50 or an extra £100, however much your raise was. Now your pot is growing bigger and is compounding at a faster rate. Now, of course, I appreciate for some this may be a challenge, but if you can, I would highly advise, as even small increments now will see bigger gains in the future. Rule number 4, do not buy individual stocks. I often hear people say if you had invested in Apple 20 years ago, your investment today would have grown by over 1,000%. The same can be said for companies like Amazon or Google. In hindsight, everything works perfect, right? But 20 years ago, there were thousands of companies that were all trying to be the next big thing, and most of them you've probably never heard of only because they didn't make it. Even companies like Tesla that are very big now were one time penny stocks that went through a lot of uncertainties and rough times. Companies like Nokia, who in 2007 had around 50% of the market share of the mobile phone industry, and it seemed like nothing could even come close. However, we know today this is no longer the case, and a certain company that has a fruit name has completely dwarfed them. Adding to this, if you do invest in individual companies, you'd constantly need to stay on top of all the latest developments and changes that in many cases happen very quickly. Your investments could tank in a short amount of time without you having the ability to react, as once the news is out, it's too late. Also, if you're investing in companies that are in early stages, you're taking a lot of risks. Most of these do not make it and end up losing money. In investing terms, these are known as penny stocks, where the failure rate is around 90%. I remember during the COVID pandemic, a lot of YouTubers were promoting these and they were raving on about how they were going to 10x. Most have been delisted while others have lost their entire value. So what should you be investing in? Which brings me to rule number 5, invest in ETFs. ETF stands for Exchange Traded Funds. What are these, you ask? In simple terms, the best analogy I would give is imagine a basket that has not one but a few hundred stocks. So when you invest say $100, that $100 is buying a small piece of each company in that basket. Some of the most popular ETFs are the S&P 500, which includes just over 500 of the largest publicly traded companies in the US. Or there is the Vanguard All World ETF. These are just over 4,000 of the largest companies in the world. What's really great about buying ETFs opposed to individual stocks is that the lower performing companies in an ETF are removed and replaced with the better performing ones. They are passive funds, meaning you don't have to actively manage them. These days, the fees are also very low. The Vanguard S&P 500 VUSA, the fee on trading 212 is low as 0.07%. Now, this is lower than the fees that you pay towards your company pension. I could probably do an entire video on ETFs and why buying them is a no-brainer. However, I will leave you with this fact. Around 90% of active fund managers, now this is where people pay financial experts to invest on their behalf, fail to beat the S&P 500 over a 10-year period. Rule number 6, start now. There is a Chinese saying that the best time to plant a tree was 20 years ago and the second best time is now, meaning the earlier you start, the better. Even the difference of a few years can make a huge difference to the overall gains you'd get on a long-term basis. For example, if you look at this chart here, it shows £500 invested over 20 years versus £500 invested over 10 years. Yearly growth rate of around 9%. See how the investing over a longer time frame produces greater returns. Also, with the availability of online investment platforms, it is now easier to start. See, back in the days, you'd actually have to go into a brokerage firm. You'd have to complete forms and pay really high fees each time. And even then, there would be a delay before they could put your orders through. These days, you don't have to worry about that. It's very simple. And on that note, if you found this video useful, I would really appreciate if you can like and subscribe to my YouTube channel, and I'll see you in the next one.